Hey friends, welcome back to the Trades Talk podcast. Another episode coming at you today. Thanks for tuning in. I've got a great guest in the studio, Kory Mitchell with Iconic Founders. You guys are going to love Kory's story. So Kory started in the mom and pop business in Iowa, the restoration specialty contractor, and scaled that to $200 million. He then exited for 9 figures to private equity in 2021 and then stayed on as CEO in 2024. We'll hear a little bit about that story today. He then left to start Iconic Founders, which he runs today. And it's an amazing business model that we're going to dive into. So let's bring Kory onto the podcast. Kory, welcome to Trade Stock, brother.
Justin, thanks for having me. I'm super pumped to be here.
Man, I'm really excited. Your story is so fascinating on so many levels. And I kind of want this podcast to be a bit of a storyline. And then we can talk, maybe first half, we talk a little bit this story, the lessons you learned, the game and playbook of private equity, and then what you help contractors do today, I think is also fascinating. Would love that to be the second half. So with that pitch and that startup, the framework, would you mind starting at this point of deciding, hey, we're going to build this mom and pop organization to something that is scalable? What was the timeline and what did that look like?
Yeah, so I don't want to, act like I had some master plan. It's one of those things that it just sort of happened over time. I grew up in an asbestos abatement company. My dad had started it. I got to tell you, I don't think anyone in my family thought I would ever end up in that business. I was like I was a school kid. I wasn't a laborer. But I grew up working in the office. My brother did too. My brother was in the warehouse. I was in the office, and I worked with the controller. So I did kind of like the boring data entry and stuff like that. So starting at the age of 14, I worked at the company all the way through college because I went to college nearby, where my family is from in Sioux City, Iowa. And so I worked there all the way through college. Then I went away to grad school. Never thought I'd come back to the business. Well, a few years later, I rejoined the company. I called my dad. I was like, yeah, I'm thinking about starting a business. And he's like, well, why do you want to do that? We got one that makes pretty good money and you could make pretty good money. And we don't have anybody that looks like you, right? Like my dad was very much a blue collar guy, didn't go to college, started this business from nothing. My brother was very, very similar to him. They were ops guys, but they weren't sales oriented. They weren't, marketing, business development. That wasn't like their thing. And so I really had a lot of things to add to the business that it just really didn't have. So this was it was an $8 million revenue business, really great business.
Yeah,
it spun off a couple million bucks in profit, and if you live in Sioux City, Iowa, that's an amazing living. And so, but what it didn't have is, it had this long history of doing good work, making good money, had good clients, but it never told a story about itself. It didn't, they never built a website, never made a brochure, never talked about this long history of the business. And so what I started working on is, okay, we got to tell this story. This is this great family business, and we can start to tell the story and spread the word, get more clients, and start to really focus on organic growth. So it all started with organic growth. And so I literally, was there 2005. My brother and I made a deal to buy the business a year later, 2006. My dad had been fortunate that they had a lot of hurricane cleanup work in the previous 3 years.
Okay.
So he got to a point where he was like, look, I kind of made enough to retire. And, if you guys like to buy this, I'd love for you guys to take it from here. I don't think he ever in a gazillion years thought that we would grow it to be a large business. And so my brother and I relocated to Colorado. He had started to do some projects out here where I live in Denver. And I started visiting him, and it was like, man, I like Colorado. Like, there's no humidity, there's no bugs. It's pretty sunny all the time. So we made Colorado the center of our universe, and we started adding services. And that was I think the big thing is we started adding different service lines. So it started out as this just asbestos abatement company, but we started adding contaminated soil, contaminated water, demolition, structural demo, interior demo. So it started out by just adding more services to the customers we already served. And then we started adding locations. So our playbook was fairly simple. We would go in and we would buy a really small player that did one of those services, demolition, asbestos, and then we would add the playbook to it and start adding the other services and adding the business development plan to it. We'd put a BD person in the business. And, 99% of small specialty contractors don't put a business developer on the business. They're like, oh, I know the customers.
Referral
and
based.
So, yeah. And so I we bought this, a perfect example. We bought this little demolition business in Des Moines, Iowa. It's still part of the company today. And it was $3 million in revenue. And we told the owner after we bought it, we said, listen, we're adding a sales guy. He goes, what is a sales guy? They're not going to be able to do anything for us. Well, 3 years later, that business was $24 million in revenue and $5 million in profit. So we added, literally, now there was some luck involved too, but, added a great BD person. We added a capabilities statement. We added big bonding capacity. We gave them confidence. We taught them how to add the different services that we offered. And all of a sudden, it was a turnkey environmental and demolition business. And so that was kind of the playbook. So we did that over and over again. And we eventually merged the business with a similar company to us in Texas that had 7 locations. And we were both 36 million in revenue by the time we did that. So that merger created a $70+ million revenue business. And then we just continued to do acquisitions from there. So all in, we did about 13 acquisitions. And we sold the business in 2021. And one of the things that people don't really understand about, like, how does all this work? Like, why would anyone pay me, Mr. Asbestos Abatement Contractor in whatever town in America? Why would anyone pay me 5 times my profit or my EBITDA? Like, everything in private equity goes by EBITDA. And the answer is when you get to a certain size and you start collecting these businesses, and if you do a really good job of integrating them, I think the biggest thing that people don't do well is integrating the business. You don't have to rebrand. If you do a good job integrating them, you add these 5 times EBITDA businesses several times. Well, once we got above 20 million in profit, that business was worth double digits, meaning that we were able to sell it for more than 10 times EBITDA. And so that's what we did. We just added businesses until we got to over 20 million in profit. And then we sold back in 2021, and we had a phenomenal result. And the rest is history.
Yeah. And we'll question on that for those listening. Why is it that if you're 5 million of EBITDA, you're selling for 5x, but then you're 20 million, you're 10x? What's the reasoning and thought process behind that from an investment standpoint? Yeah.
So first of all, what I'd say is once you pop above 5 million in EBITDA, there's also another jump. Okay, typically what you see and by the way, that's being super general, right? Because you have businesses that sell for 4 times, and you have businesses that sell for 9 times that are 2 to 5 million in EBITDA. So I don't want to overgeneralize, but just in simple terms, if you think a lot of businesses that are sub 3 million in profit or EBITDA are getting 4.5 to 6x. Well, it's just as much work to buy a $2 million EBITDA business as it is a $20 million EBITDA business. And often it's actually more work.
Got it.
Because usually if you're running a $2 million in profit business, say you're 8 to 10 million in revenue, your systems are pretty basic. You probably don't have, you're probably using QuickBooks, really good chance. You probably don't have a CRM. You probably don't have any kind of dashboard and how you're looking at your data. It's it's all fine because it's making you a great living, but it's really different than when you get to a point of building out $100+ million revenue business, you need to put some sophisticated tools in place to manage a business of that size. And so what you're buying, if you are say a large PE fund or a large family office, is you're buying a platform. And that platform, if you can buy it at, say, 10 times or 11 times EBITDA, and let's just say it's making $20 million in profits, so you're paying $200+ million for the business. Well, now guess what? Every time you buy a 5 times EBITDA business, that business the next day is worth 10 times.
That's huge.
The very next day, because you just put it into the business, or more than the 10 times. And so that's part of the magic of getting that kind of core size, is that every add-on acquisition doubles or certainly grows in value immediately upon acquisition. And you're often, just imagine this, most PE is done with debt. And let's just say you can borrow 2 times debt to EBITDA on that business. And I know I'm throwing out a lot of numbers here, so we need to make a little cheat sheet for your listeners.
Yeah,
which actually, maybe we should do that.
Actually, you should do that. Put it on your website.
Yeah. So if you can borrow 2 times EBITDA, and then you immediately put that, $2-3 million EBITDA business into a 10x business, you're almost getting it for free because you've done it all with debt. Now, so your equity value has gone way up. So it's
okay. Yep.
You see what I'm saying? And typically they're going to borrow 2 to 3 times debt to EBITDA when they're buying these businesses.
And so you mentioned integration being such an important part of this process. So that's why, as long as you can integrate it properly and smoothly and not lose a bunch of employees and clients, then you're basically, that's why the private equity model is so popular in the trades right now, is because of this EBITDA arbitrage that we're seeing.
Exactly. And by the way, integration never goes smooth. So it's always hard.
Just to set the clear expectation.
Yeah. I mean, it's hard. But if you can start to do some of that work yourself before you sell, you can really drive your value of your company up before you sell it. And so instead of giving the buyer more of the value, you can keep more of it in-house. And that's some of the work I do today. I know we can talk about that later or another time, but it's trying to give as much value to the owner as possible instead of giving it all away to the next owner.
Well, we can come back to the story. Let's dive in on that. Let's double click on that. I think it's really important and something I'm very passionate about is this idea of building a company that is truly sellable. And so many people I talk to are just bogged down because they're running operations and they're in the field meeting with clients, and then they're trying to look at QuickBooks every month and make sure their numbers are in the right place. And then you add this element of putting all these systems in place to become sellable, and it becomes this thing that never really happens, right? And they have a plan, but 2 years, 3 years, 4 years goes by, and they're still, maybe they grew 10%, but they're not sellable. How? And let's just take it from there. What's your take on that? That situation that's happening in the trades. It's everywhere right now.
Yeah, it's really, first of all, I can see why people get stuck because it is really hard. I remember being that size of business, and first of all, you also think about money in a very different way. When you know how hard it is to make, you really are really thoughtful about how you spend it. And so smaller business owners, even if they're making $1 million or $2 million, they're extraordinarily cautious about how they spend, and they're very cost sensitive. So when you start talking about adding consultants or start adding a COO or start adding a CFO or an expensive accounting platform that's $100,000, whatever it is, people get really nervous about those fees, and they don't really see how the heck am I going to get that value back? And the value takes time to get back. And so, first of all, I'll say it's fair. It's fair that people drag their feet on it, because so often owners of businesses are the main salesperson. They're they're the main superintendent. They're the main lots of hats, and they're just spread so thin that it's hard to get that work done. But What I'll say is, if you want to sell your business, what you do not want to do is sell it because you're exhausted.
Yeah.
Right. Like, and I see this a lot. People ask me, hey, Kory, you got all these baby boomers that are retiring. You must have so much business taking them to market. The people that we end up taking to market are not baby boomers. They're 45 and they're exhausted. And so what I would, and they're like, I'm just fried. I just don't see any way through this. And what they really are is they need a break, and they need, some clarity in their minds. And what I'll say is that's not an ideal way to sell, because, by the way, the next day when you sell, you still got to go back to work. 99% of people that sell have rollover equity, and they're given several $1 million or several million reasons not to leave. And so their job is the same on the next day, except, the difference is you have more work because now you've got someone that you got to send reports to. Yep. And so I don't want to paint an ugly picture, but don't solve your problem by selling a great business for less money than it's worth because you're fried. Let's take a pause and build a plan so that you can actually have a healthy approach to your job and then sell for more money than it's worth today. And, there's some of those things like putting, proper data tools in place so that you can truly manage your business. What you typically see in small businesses that are 5 to 15 million in revenue is they don't really have a sense of what their backlog is. They don't really have a forecast. They have no idea what their next 60 days looks like.
Yep.
They have a really hard time with good, high-quality job costing. So they don't really know in real time, like today, how my job is doing. It's all like, how do I feel about the job?
How do I feel?
And so there's a lot of those things that you really need. And as soon as you start going down the process of selling, you're going to get asked a million ways anyway, how to get that information. And that's, again, why it's often harder to buy small businesses, because they have a really hard time producing that kind of report. So those are some of the easy things that you can start to work on if you give yourself the space and bring in some resources to help give you the support you need to get through that.
Yeah, I think that's great advice. And it's really hard to do that. It's hard to, because I've gone through these different levels, right? We're 20 million today, but it was just 4 years ago in 2021 when we were 11 million, and we were in that spot where we didn't really have great systems. We didn't have great technology. We weren't in tune with the business, and that weighs a great deal on the founder, CEO, or president, whoever's in charge. I think a lot of stress in the blue collar industry comes from this area of unknown, this uncertainty that's in the business. And when you start to get the reports and the technology that most people fight, you start to get not true certainty, but you get more certainty around your backlog, your profitability, your jobs that are profitable, your jobs that aren't profitable. And you start to get a bit of a system going where you can step away because things are in a good place for at least a week or two. And most people will stop at the 1 yard line and not take that final step to implement that new ERP or that new job costing system, because they are afraid of the work it's going to take in that 90-day onboarding. And so they just bury their head in the sand and keep doing the same things that they've been doing. And this is I think, an interesting moment in time where 10, 15 years ago, I don't think there was this amount of interest in acquisitions in the blue collar industry, right? So we've got all these different factors working at the same time. And now we have, I got hit up this morning by 3 different people, Monday morning. It always happens. 3 different family office and 2 private equity companies, cold outreach, seeing if I want to sell. And so as a potentially burned out leader, that's a really cool email to get. You're like, yeah, fuck yeah, I want to sell. Let's go. And then you realize, how difficult it is. So, Kory, I want to kind of ask you this question, and it's just because it's the next question is, when you started Iconic Founders, what was the ultimate goal in what you were trying to accomplish? It sounds like a lot of what we're talking about is at the core of this business. Tell us a little bit about that, the story of starting Iconic Founders and the purpose behind it.
Yeah. What was happening to me? I took a 6-month break after I quit working.
Can you tell us a little bit about that, maybe? Like why that?
Yeah.
Yeah. Why'd you take a break?
Well, I was exhausted. I had spent 20 plus years building a business up and, gone through the transaction process. We had a bit of a turnaround process after we sold where I had to go through some heavy, hard lifting that sucked. And, between building the business, between going through the sale process, between going through a turnaround process, getting it back on track, I was just like, okay, my work's done here because I'd made the money. Thankfully, I had a really fortunate scenario. And I was sort of like, this is no longer healthy for me to keep up at this pace. And so I think I frankly needed it for my mental health, my physical health, also for my relationship with my family. I was on an airplane every week, putting out a fire somewhere. We had 37 offices.
Wow.
So, and there's always, any founder out there or owner knows what it feels like. It feels like everyone else in your business is actually in charge sometimes.
Yeah.
Right? Like everyone thinks, you're Mr. Owner, rich guy, whatever, that you got the world by the balls. But the reality is everyone else has you, I don't want to say by the balls, but by the balls.
You're serving them, honestly.
Yeah. So I got to that point where I was like, man, my family's home. My family gets kind of the worst part of me because I'm stressed and tired. I get to the Saturday, I want to nap. And then I'm trying to convince people in Jacksonville or Des Moines to not quit, because you really need them because they own the customer set and they have the relationship with the project managers and all that kind of stuff. So it got to a point where I kind of felt like I'd lost a little bit of control and wasn't having fun and wanted to take care of my family and make sure that that became number one again. My kid was 6 at the time and I had been traveling for 6 years. So, that was really important. So I took that time off, and during that time I really focused on health, and I was working out all the time and walking, and we traveled as a family. Took my kid to 14 countries, and it was amazing. It was best decision of my life. But while that was happening, by the way, I quit and I'm like, I don't know if anyone's ever going to call me again. You don't know. This is the fear that owners have when they leave their business because it's your purpose.
It's your life.
And the reality is I had so many calls, and I had people calling me for all different reasons. I had PE companies calling me, asking me to be CEO. I had people calling me to be on boards, which I did eventually join some PE-backed specialty contractor boards. I'm still on several. But the interesting thing that happened is a lot of owners were calling me and they say, Kory, I've watched you on LinkedIn. I've watched your playbook. I've seen what you've done. I saw you had this really successful sale. I don't know how to do that. Like, I have no idea how I would even think about doing that. Can you give me some advice? Would you consider coaching me and things like that? So after having a number of these calls, and then I started flying around looking at deals because I thought, well, I'll just buy another business. I looked at landscapers. I looked at glazers. I looked at restoration contract. I looked at all kinds of businesses. I thought, I'll buy another one and I'll run the same playbook. And everyone took my call. Because when you get a call from someone that's a specialty contractor, as opposed to, say, a PE fund,
right,
or an investment bank, guess what? People take your call. And so what I realized is, one, a lot of people actually are really craving someone in their corner. And two, I have a special kind of knack to be able to connect with owners, which is a way that you can get business. And so I developed the business, and we really do two things. We take businesses that are already making, $2-3 million in profit or more. Our size is 3 to 25 million in profit. And we take them and help them to transact and help them sell. But we do it from the lens of a founder, as opposed to the way an investment bank might think about it, because I've been there myself. I can share the experience with them and the reality of what it's going to be like. What I've found, and I don't want to trash talk investment banks, but investment banks tend to tell you what you want to hear before you sign the agreement.
Right.
And I tell people what's really going to happen. And it's hard. Selling a company is hard in lots of ways.
Yeah.
Whether it's the due diligence, whether it's the personal identity, whether it's losing your cash flowing business and going to a lump sum nest egg. Like, there's all these things that are really, really hard. And then the other thing that the business does is we do what I call value creation work, where if a business is, again, makes over 3 million in profit, but someone tells me, hey, Kory, I really want to do what you did. I want to grow, but I don't know how. I just don't know how to do it. Can you work with me? So we work with folks, and we build a value creation playbook, and we value the business at the time of our engagement. We essentially get in a sort of partnership with owners to help them get to a bigger, more valuable exit down the road. And then we bring in a former CEO that's been through the scaling and exiting processes as well, and we put them as a coach on the business. That's been super fun. Now I have, I think, 8 of these exited CEOs that have sold businesses ranging from 100 million to $1 billion that are these incredible people. So I kind of now have this cool peer group around us at Iconic as well. So combined, the transaction advisory business and the value creation business, it always feels like we're helping, like truly helping. I don't want to do any client that it doesn't feel like everyone's winning.
Right.
I was fortunate where I kind of took the money thing off the table. And don't get me wrong, I still want to make money in this business. It's a for-profit business. But if it's not going to be fun and if it's not going to be a win-win, I don't want to do it.
I think that's where, funny enough, that's like where the best businesses are created, is when people are making the business and the model and the purpose out of having fun and helping versus I'm going to go and create the most money. Like, yep. Most of the biggest companies today, even like Amazon and Jeff Bezos and Elon Musk, like, you don't hear those guys saying like, I'm going to do this because I'm going to make the most money doing it. They just do it because they love it. They want to change the world. Now, I really, really like the fact that you've brought these 8, and probably it's growing, exited CEOs to the table, because I talk to a lot of these guys and gals, and the biggest thing that I hear is they are left in like kind of empty after a sale, because they've been helping and serving their hundreds or thousands of employees, and now all of a sudden they're under someone else's care, and they're like, what do I do next? Where do I put this this to work? And so you're giving them an outlet to go and do what they're great at. And the business who is looking for value creation, and let's just run this playbook. So let's say K&D, for example, it's a great example, where, 2 to 4 million in profit, let's say, let's just call it 3 million. And, just for hypotheticals here, let's say we want to sell at some point, but, we're not quite ready. We know we can get a couple more million in EBITDA. We'd like to be 5 or 6, get that next kind of bump in multiples. How would you guys approach working with a company like us and get us to that next level? Tell me a little bit about your strategy that you would lay out.
Well, first thing we would do is I would do a deep dive and better understand the business to make sure you're actually a fit and that we're a fit for you. Like, we have to, would do, because I want to know, like, can we actually help? If we can't help, I have no interest in like retainers. Like, retainers for me, that's not how I want to make money. And we pass the retainer through to the coach anyway. So
got it.
We don't make any money until we create value at exit. So for us, it's a true partnership. Like, we want you to create value or we're not going to make any money. So the way it would work is we come in, we do a deep dive with you in the same way we would do diligence if we were buying a company. We'd get under the hood. We'd spend a couple of days. We'd spend some time in person. We'd go out for dinner. You know, like I'm an in-person kind of guy. I want to know if we like each other and if it's going to be fun working together. If it's not going to be fun, I don't want to do it. If we can create value. Then if all those things are like, okay, check, 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 then what we would say is, okay, well, let's figure out what we think the business is worth now. And then what kind of things can we do now that we know more about what it needs? What kind of things can we do to get your business from, in your case, say 3 to 5 million in EBITDA? And then once we do that, we start building out a value creation plan. But at the same time, we're going to partner you with one of our exited CEOs. And you'd kind of do a little dating with them and say, hey, you know, here's 1 or 2 people that we think are a great fit for what you need. Like they're really good at, say, go-to-market strategy because you really need a go-to-market, or they're really good at finance. Yeah. Mm-hmm. We might even put 2 people on it. We put like an exited CFO and a CEO on it. And we'd value the business. If you agree that you like the coach or coaches, we come up with a retainer that makes sense. We pass through the retainer to them. And then what we do is we take a percentage of the difference in current value and future value when we sell the business. And then we want to work with you to also do the transaction at the time of exit. So the way we would make money on that is if your value goes, let's just say in your case, let's say the business is 3 million in EBITDA, and let's just say it was worth 5x at 15 million. We say, my goal is to get to 30, whatever the number is. We would take a percentage of the 15 delta, and we would like to do the transaction advisory, and we would make some money on the transaction advisory as well. So for us, we really make money in 2 ways, and our goal is that we have so much trust built up because we've worked in the trenches with you for that 2-3 years. It's probably going to take. That, of course, we're going to work together on the transaction advisory. And, of course, you want the fees and all that stuff have to all make sense. But that piece is the easiest because our fees are more competitive than any investment bank. So,
and you got the relationship. You understand the business. You've been doing due diligence like the entire time.
And then so that coach is working with you weekly, and they're like in your corner. So you have like almost like a business shrink. Think of it that way. Somebody you can call that's in your corner. And then we're doing a monthly review to see how we're doing against plan. And then other of us at Iconic would be on the quarterly value creation plan review. And that'd probably be like a 3-hour deep dive, probably be remote. And then maybe once a year we go do like a in-person all-day session, like at the end of the year or whenever it's convenient for the team. So you have like this team around you, and we have access to some of these other CEOs. If we need to bring someone else in, that's like, hey, you know, you've done X before. Can you come in and help us? We've got these other people around the table. And then we share that value creation fee with the coach. So the coach is also incentivized.
Yeah.
And so all together, again, we only get paid if you make money. The coach is incentivized in a way that's typically better for them than a board role would be. Because to your point, all of these men and women that are exited, they really want a way to give back, but they don't know how to find the roles. One of the things that I've been able to do is find a lot of these opportunities, and it's been great connecting the dots.
I bet.
Because again, it gives them a ton of value and meaning to have someone that they can talk to every week and know that they're truly helping.
Yeah, and actually get to see every month and every quarter in the value creation review of like, hey, our TTM, our trailing 12-month EBITDA went up from 3.2 to 3.5, or, you know, we're on track. And then
or
it's
if
like
something goes wrong, you've got someone in your corner, right? Because it's not always going to go right. I mean,
you're like,
I can guarantee you it's not going to be straight up and to the right.
No, man. And it's so challenging when it's a people issue at the executive level or the leadership team level. I've dealt with this a lot because you can't go and talk to your team about this. You've got a leadership team of like 5 to 7. And if one of them is maybe a person that you're thinking about replacing, you can't go talk to the other 4 or 5 people about replacing this one. It doesn't create a good environment. So you have to have someone external. And I think that service alone is such a value add to any CEO. I've been lucky enough to have a coach for the last 10 years, different coaches along the way, but I think it's a non-negotiable. Like, I believe like I'll always have a coach for the rest of my life, probably forever, at least maybe a mentor in the future. But so tell me this too. When you're building out these value creation strategies and you're looking at the market, I know you guys are in so many different specialties. What are you seeing in terms of, everyone's talking about recurring revenue, let's say commercial maintenance, right? Versus, let's say, roofing. And historically, roofing's been like, hey, your roof is leaking. Let's replace it. But we're starting to see more recurring revenues show up in almost all service areas. Are you guys seeing that as part of this value creation strategy where you're trying to find a recurring revenue element in every business?
Look, not every business can have the same level of recurring revenue as, say, commercial landscaping, where the grass grows every week, right?
Yeah.
But yes, so the first thing you have to do is you have to evaluate the industry itself. Okay. So when you start with a value creation plan, and let's just say it's in either the two you mentioned, commercial landscaping or roofing, you do a market study and you say, what is the market like or dislike about these businesses? And then when I say the market, I mean buyers, right?
Good point.
What do they value? So we do a market study first thing and say, okay, well, we know where we are and we know what the market likes. Now we have to build a bridge to get there, or get as close as humanly possible to what the market likes before the time of a transaction. And recurring revenue is just one of those things. And for roofing, as an example, roofing's tricky because a huge amount of roofing is insurance driven and storm driven.
Right.
And so as an example, one of the things the market hates, if you're a roofer, is that if you're 70% insurance, because you can't plan for the windstorm.
Yeah.
No buyer wants to buy at a peak, and they don't want to catch a falling knife because they just, they don't know where it's going to drop to once the storm goes away. And so you really want to, in the case of the roofing, you want to build up the types of customers that are going to be repeat and recurring, with or without the windstorm. The windstorm becomes, or the hailstorm or whatever, becomes just, the cherry on the sundae, but not the core driver of the business. So those are the kinds of things that you'd want to better understand about the market before you build what you want to look like. And there's a lot of things that people don't understand. This is one I talk about all the time, and I'm a sucker for this too. I mean, I used to love to win a big job, right?
Yep.
Everybody wants a big job, and I'm not telling anyone to ever pass on a big job. But what I am telling you is that when you go to sell the business, if you have one big ass job, they're not going to pay you for it. They're going to say, well, what did you have without the job? That's your normalized revenue and EBITDA. So take the job, take the profit, but just know that they are not going to give you full value for that. Because a lot of times people say, well, I want to sell now because I got this big job for next year. I got my whole revenue already covered. Well, if 70% of next year's revenue is one job, that's not what anyone wants to buy. So large job sizes is one thing. Most owners I talk to think large job size equals good. It's actually equals bad. The smaller the average job size is actually, in general, depending on the industry, better. It's one of the reasons general contractors have a really hard time trading, because they're so lumpy. Buyers do not like lumpiness. They like consistent, repeat and recurring revenue that they can count on with consistent margin profile. Wow. So there's a lot of those kind of things that you look at. And so that's when you start with the value creation plan, you start with what's end state, and end state is what does the market want us to look like so that we can build towards that. And you want to start putting things in place today that'll help you get closer to that by end state.
I mean, this is fascinating for me because, in the last 10 minutes, you've opened my mind up to things I'm already thinking about because I get to interview all these great people on the podcast. But the average contractor is looking at how can I build the best business? And their definition of the best business is, I think, very different than the definition and the argument that you're putting forth, which is the most valuable business at time of exit. And so if you're a contractor and you're focused on just building the best business based on what you know and based on what you see around you, you may not actually be building towards a sizable, or maybe, you're not building towards an exit that you potentially could be getting, because you're just building a great business versus building a great business that the market wants to buy, as you said. And
what I would argue is they don't have to be different. I mean, think about some of the things that buyers want. Okay.
Yeah, I love this. Go ahead.
Right? They want transparency in their financial systems. Well, if I own the business, it's a hell of a lot easier to run the business if I have really good transparency on how all my team's doing, how my sales team's doing, how my production team's doing, et cetera. So I would argue that would make my business easier to run and give me, it's easier to sleep at night, or at least it tells you what you need to be doing differently if you've got good information in real time. Management, succession plan, right? Buyers want to know that if you drop dead or if you quit the day after they buy it, they've got a team in place that can keep running the business. I would argue if you had a really good team in place, they would make your life better because it doesn't all fall on your shoulders. And there's you go down the list and recurring revenue. I know this. It's I'd be nervous as hell if I'm going into January 1 and I'm like, well, shit, I got 3 weeks of backlog. Well, if I have a system built up where I've got a pretty good idea of how recurring revenue is going to keep coming in, I'm going to sleep better at night. I would argue that makes the business better for me as the owner. So I think that a lot of the things that the buyer wants are also actually very good for you as the owner as well. Yeah. And I would advocate to do them whether you want to sell or not.
And I totally agree with this because it's now giving us more data and more perspective in where to build our business. Before, you're trying to build a business and you bring up great points, good management team, recurring revenue, stable cash flow. But with so much more influence and impact from private equity and investors, we now have this new lens to look through and ask, are we building a sellable business that we never want to sell? And that's the argument, right? Is why not build a business that's sellable every day that runs so well you maybe don't want to sell it, and then you get 100%. The option. Yeah,
100%. Right? I mean, I met a business owner the other day. Says I want to sell, and I got under the hood. I looked at the business. I was like, "You sure? This business is unbelievable. You're working 4 hours a week and you're making $4.5 million in net profit,
right?
And it's on 24 in revenue. So, not 4 on 40, 4 on 24. So I'm going, this is like a dream. So are you sure? Because you could also let it run for another 5 years and make another $20 million and then sell for the same or more money. So I don't ever talk anyone into selling if the business is phenomenal. And I always say this, if the business is running you, maybe you should consider getting out. But if you're truly running the business well, you definitely have that optionality, like you said. And that's where you want to be. You want to be selling from a position of power, not weakness.
Mm-hmm. Well, it seems like that's at the thesis of what you guys are doing at Iconic is exactly that. You're building these businesses up to then have the confidence to go back to their coach or to your team and say, have that conversation, because I've been on a ton of calls with private equity and dinners and what have you over the years. And these guys are very intimidating as a contractor or as an owner or founder. You're in a position of it's a bit of you're impressed with their knowledge, but you're also intimidated. They know more than you. And you're just kind of in this, you feel like you're at a disadvantage. And it's
definitely,
yeah.
This is why I would never recommend going into those conversations alone. Mm-hmm. Whether you hire us or someone like us or even a great deal attorney, don't hire your local mom and pop lawyer. It's got to be a real deal attorney. You don't want to be going into those conversations alone, because that's when you lose your leverage. So bring in a trusted advisor that actually knows what they're doing and also knows the value of your business, so they can truly advocate for you so you get the best deal for yourself. Not only the best dollars, but the best deal for yourself.
Great point. Elaborate on that. What do you mean by the best deal versus the most dollars or the best dollars?
There's a lot. I mean, look, the way LOIs are written, it's not just the dollars on the paper. Okay, there's a lot of pieces of how deals are structured, because oftentimes, there'll be this number. You'll see a big number, and you're like, oh my God! I mean, that's life-changing money, whatever the number is to you. You see 20 million. Let's just use 20 million. $20 million is the indication of interest, and then there's a lot of ways to skin that cat on how you build up to the 20 million. First of all, so just talking dollars, typically there's cash at close, there's rollover equity. Rollover equity means you're typically rolling a part of your proceeds into a holding company that is now going to be this private equity vehicle that they're going to keep building up and sell at a future date. Private equity only buys businesses to sell them at a future date. They don't virtually never buy them just to hold them forever. And so you've got cash at close, rollover equity. Then you typically have an earnout, not always, but there's often an earnout. And the earnout could be part of the 20 million, or it could be above and beyond the 20 million, depending on how the deal's structured. And then how that is calculated and how you get paid out on it is wildly different. It can be negotiated in wildly different ways. Then on top of that, huge differences in working capital. The biggest place deals fall apart, one of the biggest places deals fall apart, is fighting over what working capital is. And we don't have enough time on this show to talk about that, but you need someone in your corner to help you negotiate working capital, because when you sell your business, no one wants to buy a business and the next day have to put millions of dollars into it. So they assume you're going to leave enough working capital in the company that it can operate the very next day without them putting any more money in. And so that negotiation is critical, because it might mean you have to leave $2-3 million of cash, plus the receivables and other assets in the business. Or it could mean something totally different, that you actually get paid out a big chunk of that money. And so how that's negotiated and how it's trued up over the next, say, 3 to 6 months really matters. And on and on and on and on, because there's also, you have leverage in how your employment agreement is written, because you're going to sign an employment agreement 99% of the time if you're staying, which most people stay. How that employment agreement is written matters. How your bonus agreement is written matters. How your profits interest units for your key employees, think of them as stock options, how those are going to be distributed so that you get your people taken care of. How cash could be given to your people at the time of the transaction as a bonus. And there's another 20 items. And so if you don't know anything about this, because and by the way, most people don't, because why would you?
Yeah.
Like 99.99% of people have never sold a $20 million business. So why would you know that? That's why you need someone in your corner that can support you through it and make sure that you're, again, coming at it from a position of leverage, not a position of total weakness where you just are accepting whatever they're sending to you.
Oh gosh, that was a really good point. Many good points. I think the working capital and the other wild card, the left hook at the end is, no debt on the trucks or the equipment. So, you got to pay off all the debt and you got to leave X amount in the business. And that wasn't stuff you were really thinking of. Like, it was in the fine print. And I know,
by the way, one more big one.
Yeah,
I'm sorry to interrupt you. One more big one. Very often entities are converted from an S corp to an LLC. And there's often a huge income recapture because of depreciation you've already taken. And that's ordinary income at the time of transaction, not capital gains. So negotiating that piece of the deal is really critical. It can cost you millions of dollars in taxes, because it's not about how much the purchase price is. It's how much you're left with.
Yeah.
Post-tax,
like any job,
right?
Like any job, right? It's not how much the contract value is. How much do you walk with?
Yep.
That's a really good point that most people overlook. They just think, I'm going to just pay my taxes and I'll pay the piper. I'll be fine. I'll buy some homes and I'll, depreciate those. I'll be fine. It's a common mistake there. It sounds like is the tax planning.
Big time.
Wow. So question, just because it was brought up and we've talked about it a few times, the difference between private equity and family office. When you're looking to take a business to market, do you have a preference? And maybe if you can, maybe like what's the 1 minute summary of the difference between those two investors?
I mean, look, family office is typically either a very, very wealthy single family or a large multifamily where they're collecting lots of very wealthy people and they're helping to invest their capital in a way that is diversified from, say, the stock market or real estate or whatever. It's just one more bucket that you're investing for diversification. Family offices tend to have a little bit more flexibility, where if they want, they can hold forever. For example, some family offices buy and just hold forever just because they want cash flow. What I would say is that many, many family offices, however, operate exactly like private equity. And in fact, they're hiring their people from private equity or training them in the very same manner. And they're also putting debt on the balance sheet. So oftentimes they end up looking very similar. It's just that where the original equity or the capital came from is different. Private equity tends to be, they raise their capital typically, and again, there's a lot of different versions of this, but just a simple version is they raise a fund and they get commitments from various sources. And those can be large insurance companies, pension funds, endowments. They tend to be these large institutional investors as opposed to individual investors that are very wealthy. They often don't need individual investors unless they're enormous size checks like 10, 20, 30 plus $1 million checks. And so but in a lot of ways they operate very, very similarly. So again, you really have to understand the way that PE fund operates or that family office operates, because they come in every shape and size. There's small PE funds, there's enormous ones, there's small family offices, there's very, very large ones. And they all have different philosophies of investment. So you really want to better understand how they're going to treat your company post-close. And the way you may want to do that is by interviewing several people they've already acquired.
Yeah, that's the most logic answer, right? Is like, go talk to people who have been there through their process. But thank you for that explanation. I think it's important to highlight this stuff. And this is fun, exciting. I love talking about this because it's in a way a bit new to our industry, to the trades industry, this complex investment talk and discussion. But it's like the more we can understand about it, the more we can leverage it to create generational wealth for our teams, our families, and for other owners. And I do think there are so many amazing companies out there that are not going to get the dollars they deserve because they don't put the work in to really build the sellable business. So I want to commend you guys for building what you're building and putting the team together. So Kory, as we start to close this out, I love to ask the question at the end of every episode, is just a trade secret that you guys have, or that you have, a trade secret that you would like to share with our audience that you've picked up along the way.
Oh boy, I feel like I've just given away a lot of trade secrets. Geez. I think that trade secret, there's several things. One thing that I would think about is like the value creation piece. The reason we do value creation plans is that's exactly how sophisticated investors think, right? When they buy a business, the first thing they do is they build a value creation plan. They say, how are we going to realize the maximum value out of this investment? Because they've got one main goal, and that's to realize value on their investment. And so I think learning what really smart investors and how they think about assets such as a specialty contractor, because it's for them, it's an asset. For us, it's like our identities and our livelihoods. For them, it's an asset. When you learn the kinds of things they think of in that secret sauce, and you can do it yourself, you're really taking a huge amount of the power away from others and realizing that value yourself. And that's why I love doing this value creation work, because we're literally just taking that exact same playbook from really, really smart people. And I've seen it now from the other side several times. The boards that I'm on, right? They're the same thing. They're rapid aggregators, right? I'm on a National Tree Services business board. And, you know, I get to see every time on the investment committee, if we're buying a business, well, what do we do when we're looking at the rationale for buying it? Is we say, well, what are we going to do with it after we sell it? And that's a value creation plan. After we buy it, what are we going to do with it? You essentially build a value creation plan for each investment pre-transaction, and then as soon as you close, you start implementing on the plan. And so having that knowledge base of seeing what behind the curtain of how the buyers actually think about these investments after they close, having lived it as a CEO under a large PE fund and then running the value creation playbook, and now having kind of worked on it for the last several years, I strongly advocate to owners now that they run as much of that as they can so that their business is a better business, that they're coming at it from a position of strength, and that they ultimately realize higher dollars for themselves and any other stakeholders in the company. I don't know if that's a trade secret, but it's something that I advocate a lot. And anytime I meet with an owner, I think it's one of the reasons why owners, when I sit down with them, get excited, because they hear about all the possibilities and they're like, oh my God, I didn't even think about it from that perspective. And so I get a lot of, it like rings my bell, you know, when I can go and sit down with an owner and feel like we're adding some value to them and that they're going to implement it, whether they work with us or not, even if they just take a few kernels of wisdom from the time that we meet and run it. My goal is that the good guys win. Like, that's the goal for me, is I want the good guys to win. And if I can do it with them and we can make money together along the way, even better.
Even better. I think that is a trade secret, because you're defining this in a value creation plan. It's what every investor puts in place. And that's why the job of the CEO post-sell is so much harder, because now you're running your business and you've got this value creation piece that is being pushed upon you for good reason. And it's like, why don't you do that yourself today? And you make a great point for that. We have a great strategic plan, but I don't know if I could say it's a value creation plan. So I'm going to go back and do some cooking myself and see what I can come up with. But Kory,
awesome.
Thank you so much. So where
my
can
pleasure.
people?
So let me plug my podcast if I could. I'm following in your footsteps. I'm interviewing blue collar owners who have sold, and they tell their stories, you know, good, bad, and other. And I've had such a great time interviewing all these guys, and they're people that have sold their businesses for 10 million all the way up to hundreds and hundreds of million. We had someone sold for over $1 billion on the show the other day. We've got 6 months of content recorded, but I think we've only released 3 or 4 episodes so far. So you can find us at iconicfounders.com, and you can click on our podcast right there. And it's available on every channel, from YouTube to Spotify and everything else in between. So I'd love it if people tune in. And then if we can support any of your listeners out there, we would love to be a resource. I'd love to have a conversation with any of you.
Yeah.
You're doing them a great service by having this show. So thanks for the work you're doing.
Oh, my pleasure. And I'm excited to tune into your podcast. The Turn is what it's called, right?
The Turn. Yeah.
So check that out, guys. Go subscribe. And if you're interested on maybe being on The Turn, if you've sold, reach out to Kory and his team over on Iconic Founders.
We'd love it.
Dude, thank you so much. This has been a great chat. And I just want to say, I think this industry, just the blue collar industry, is so alive right now. And thank you for the work you're doing. I think you're advocating for the contractor here, and we need more of that. So with that, we'll wrap the show right there. So Kory, thanks so much for being on, bro.
My pleasure.
Thanks for tuning in to Trades Talk, where the next generation of disruptors comes to raise the bar. If you got value from today's episode, share it with someone in the trades who's ready to level up. For more tools, insights, and community, follow host Justin White and join the movement at jwhitegroup.com.